We'll talk today about planning for the exit or the landing. And 3 things I really want you to take away today. What are the things you need to do, or what are the things that your clients need to do to be ready to sell or transition a business? What is the right team that you need to assemble around you to accomplish that? And what are the exit strategies? And also we'll talk about actually preparing to sell, the housekeeping that needs to be done to get a business ready to be sold. When we're preparing to exit our business, what are the things we should be asking? What are the questions we should be asking? And the first question you always should be asking your clients or yourself is, what do I need to exit this business? And what do I want to exit this business? And we'll focus on that a little bit. Goals and objectives, needs and wants. Financial planners are key to this role. What exit strategy is going to generate the best economic result for me, for my family, for my business? How's the exit going to impact me? And how is the exit going to impact my employees and my business going forward? We'll talk a little bit about that. And what kind of estate planning can I do in advance to make sure that I minimize the tax consequences? So we'll talk a little bit about pre-transaction estate planning. Some of you I know are really familiar with those techniques and tools. And in your package today, hopefully there's a handout that we'll focus on in a few minutes. So when we're talking about goals and needs, what we want, what we need, how do we project what the end result is going to be, it's not just about you, or is it? In some cases, in my clients' situations, they want to get their first exit, they want to get their money out of the exit, and how do they do that, and what should they be focused on? And then there are those that have exited multiple times who've amassed massive amounts of wealth, way in excess of the exemptions from estate planning, which are close to $11 million today for a married couple, should they have some charitable donative intent, and how will that help them? So you can accumulate wealth for yourself and your family. You can accumulate wealth for eleemosynary charitable purposes. But first you have to figure out what you need to live on. And so really the CPA and the financial planner are critical to this process. They're going to help prepare projections for the client so that, working from the end backwards, you know what you need, you know what you want in order to sell this business. That really should be the starting point for any kind of analysis as to when you're getting ready to exit a business. And it's after income tax, after potential estate taxes if you want to pass on wealth to the next generation, after transaction fees, the investment banker and lawyers that are going to charge for the transaction. And often you have to sit down with the client, particularly if it's a small business, and compare the net result, the after-tax result, to what they would get if they just held on to the business for 3 or 4 or 5 more years, if they can continue to operate the business for that long. And that's part of the analysis of every client sale that I go through. And hopefully that you'll be dealing with your clients. What's the best economic result? First of all, to determine the best economic result, I have to understand what the market is for my company before I sell it. And is it even sellable? What's my business worth? What can I get from my company? Can I pass it on to the next generation in lieu of selling it, and giving it away to somebody else? And who are my potential buyers? In terms of evaluating the market, it's good to know some people who might know about your business. So dealing with investment bankers, business brokers, we'll talk about the difference between the two in a second. Business consultants, people who actually help with strategic planning for businesses. And in my opinion, talking with people who have sold in your industry previously and recently, not 10 years ago, but in the last couple of years, is a really good source of information to determine what your business might be worth, particularly if it's of a similar size. And of course, talking with your attorneys who have experience in selling clients and dealing with merger and acquisition transactions, and last but not least, your CPAs, because they're handling a lot of these transactions too. So knowing what the market is for your company is absolutely critical. What's it worth? Well, who's going to tell you what your business is worth? You probably know better what your business is worth than most everybody else. But sometimes we have to ask outsiders because we may not know what the business is worth, and we don't know how to price it. It's almost like having a house in today's market. How do I price this house so that it moves quickly so I can get the right price? Well, business is not a house. It's not a finite box. It has a lot of components that are easily definable. So do I use an appraiser, a business appraiser, or do I go to an investment banker? What's the difference between an appraiser, a valuation expert, who has a certified valuation analyst or appraiser designation versus an investment banker who doesn't? Anybody? What's the difference? John?
Methodology.
Methodology? Okay. What would be the different methods that the appraiser would use versus the investment banker in terms of valuing a business? And why do appraisers exist? Why are they there? Why do we have them? We have to have them in some cases, right?
Impartial.
Yeah, objective.
To be objective, to be impartial. They're also conservative, and they're used, in different circumstances. And the values that you derive from an appraiser, a business appraiser, will be different from circumstance to circumstance. So, for example, if there's a divorce and you have to value the business to determine the value for purposes of paying out a divorcing spouse, that might come up with a very different analysis than if you're doing it for estate and gift tax planning. Usually the estate and gift tax planning valuation will err on the side of being lower rather than higher. That's the ultimate goal, but it has to be justifiable. So the appraiser is going to use different methodologies. They're going to use discounted cash flow. They're also going to use comparable company sales, any other companies that are being sold in the marketplace. And they're going to be using, standard industry multiples that might be applied to the particular business in the industry for the size of that business. But they're going to be very methodical about it, and they're going to have to prepare a report, sometimes upwards of 100 pages, that will analyze the business in extraordinary detail. The investment banker is looking for fair value. What's a willing buyer going to pay for this business today? In a marketplace that exists today. And so the investment banker is looking to sell the business, and they're looking to really generate higher value, if it's your investment banker particularly. They're looking to generate a higher value for the seller. And so they will use typically a simple multiple of earnings before interest, taxes, depreciation, and amortization, EBITDA, or cash flow. But it's not as simple as you think it is, because the multiple is a function of the industry, it's a function of the size of the business, and what cash flow is, or free cash flow is, has to be defined based on that specific business. And we'll talk about that in a second in terms of add backs and other things that you have to do to figure out what the real value of the business is. But clearly, you don't want liquidation value for the business if there's goodwill associated with it and it can generate a higher multiple for you when you sell the business. In most cases that I deal with, where we're selling a business as opposed to liquidating it, the sale price is reflective of a significant amount of goodwill, the ability to generate cash flow into the future, even if the founder is no longer associated with the business. So that goodwill is the function of that multiple, and that goodwill is an intangible asset that's very difficult to wrap your hands around and put a valuation on. But a willing buyer will pay a willing seller. That's fair market value. Liquidation value is if we sell off the pieces. And in some cases, and I have a business right now that's liquidating, in some cases the business is worth more broken apart, sold in pieces, than sold as a going concern.